Well, good afternoon, and welcome to Chicago and to our 2017 Connectiv Executive Summit. We're really delighted that you've been here. It's been a full day already. We had our digital marketing boot camp, which ran until about 4, and then a session, a pre-con session, and we're delighted now that we're here for the main event. This is always an exciting time for the board and the staff, bringing together our CEO community, so we appreciate your participation and engagement for the event. So let's get to the heart of the matter. We have our opening keynote tonight, followed by our networking reception and dinner. And tomorrow we'll have a full day of really forward-thinking and thought-provoking sessions and presentations. But first, some housekeeping. Wi-Fi is made possible by Storyports, and be sure to download the conference app to get all the information you need for our meeting. If you're tweeting, which we hope you are, here's our handle. And if your mobile runs out of power, Omida has charging stations just outside the sponsor area. And speaking of sponsors, we'd like to thank our 13 partners who've helped make our meeting possible. Please join me in recognizing Alliance for Audited Media, BPA Worldwide, Computer Fulfillment, JAGI, Kohler Search Partners, Lytics, Mazars, Media Radar, Multipub, Omida, Real Magnet, Storyports, and TV Worldwide. Let's give them a round of applause. As we started preparing the theme and the topics for this session, we really started thinking about last year what was on the calendar, both of the political, social, and economic winds that were blowing. And as we progressed through Brexit, the 2016 election, we really thought having someone that could speak to the geopolitical and economic issues would be a great opportunity to sort of set the stage for the discussions that followed as they affect our business on the national and global level. So as we've been through probably one of the most unpredictable and tumultuous periods of our history, I'm really delighted to welcome Michael McDonough, Chief Economist for Bloomberg, to tell us about the roller coaster that we've been riding on and where it's heading. So please join me in welcoming Michael.
Thanks. Well, if you think it's been tumultuous so far, get ready. But so yes, I'm Michael McDonough, Chief Economist at Bloomberg. If you like what I say or like the charts I put out, feel free to follow me on Twitter because I do update them and put out a lot of new, interesting charts there as well. So I do feel like if it were not for Donald Trump's election, I probably would not be here today because we'd be in a much more certain environment than we are right now. And what I wanted to start off talking about is something undoubtedly everyone in this room has noticed, and that is the equity market has done extraordinarily well since Donald Trump won the election on November 8th. And I mean, for lack of a better words, I'm paraphrasing here, but it was a surprise to most everyone. Most analysts thought that once Trump won the election, uncertainty would rise, financial conditions would falter, and equities would probably fall. But what actually happened was markets began pricing in Donald Trump as basically the Messiah, right? You saw an unprecedented rally in equities. You saw an unprecedented rally in optimism. And why? So there's really 4 things that have driven this rally. One is that the market continues to believe that there's going to be a relatively dovish Federal Reserve, meaning the Fed is not going to hike interest rates too fast. They're going to hike interest rates, but not, to a point that is going to hurt financial markets. That there's going to be no major disruptions to international trade, which is interesting when you considered what Donald Trump ran on. Industry deregulation was another pillar. And then finally, and probably the most important pillar, was tax reform and infrastructure spending. So the market basically had the belief that this is what was going to happen. And what's really interesting about this is this means, since none of it's actually happened, and we haven't gotten a lot of details about what really will happen, the entire thing is being driven by optimism. And this chart may look somewhat innocuous, but is unprecedented. And this is the most shocking data point I have seen since the election. And basically what this is showing is the University of Michigan publishes a consumer sentiment survey. And as part of that survey, when they're on the phone with the respondents, they ask the question, have you heard any news? Open-ended question. And what they do is they quantify the responses. So this is a chart of the percent of respondents who unsolicitedly said something positive about government economic policy. So prior to the November election, since 1978, about 2% of respondents would just randomly say something positive about government economic policy. Since the election, it's jumped to about 30%. This means 30% of the 600 people University of Michigan are calling are saying, you know, Trump's economic policy, we're going to create a bunch of jobs and we're excited about this. And this is what is really helping drive markets up. But here's the problem. When you actually, you may have heard the headlines that economic data in the U.S. is doing far better than anyone expected it could. It's coming in far above expectations, which is true to a certain extent. But the reality is, the data that's beating expectations is all based on survey and sentiment data. So things like the ISM, the PMIs, where you just call someone and say, how do you feel about your business? The responses have been very positive. In fact, the orange line in this chart represents the economic surprise index that only reflects survey data. It surged. The problem is the white line, that represents the economic surprise index for hard economic data. So that's what actually drives the economy. Retail sales, industrial production, etc. It hasn't budged. So this is a bit problematic, and you could see you're already seeing the orange line start to moderate, which makes sense. Now, why this is problematic is because, you have seen the market go up quite substantially, and eventually, as it gets baked in that, tax reform will probably come, but it won't look anything like what the market currently anticipates. Healthcare reform, this started with healthcare reform. If you actually look at where sentiment started to dip, right? The market was optimistic, thought Trump was going to get this stuff through, saw what happened to healthcare reform, saw he didn't have cohesion within his own party, and that's when this began to crack. And this is going to continue to crack. But on healthcare reform, this is another very interesting chart. I was trying to figure out some way to quantify, is tax reform really something that's driving the market, or is it something more nebulous that we can't identify? This chart takes basically all news, all research, anything that comes over the wires on the Bloomberg terminal, and I think there's tens of thousands of wires aggregated by Bloomberg, and then tracks how many stories are talking about tax reform and how many stories are talking about healthcare reform. And you can see when there's a lot of red, that basically means this index I created is shifting towards healthcare is the main topic of the day. When it's green or less red, it's shifting to tax reform. And the white line's the S&P. So it kind of shows that when healthcare reform became the topic du jour, the S&P didn't do very well or it was flat. When it shifted more towards tax reform, the S&P did very well. And more interestingly, in terms of when could we start seeing sentiment really crack and the market really start coming down, I showed you the percent of respondents who said responded positively to government economic news. Well, the peak for respondents who said something negative about government economic policy happened during the last government shutdown. And you could see some of the rhetoric already that Trump is threatening government shutdown in September, and potentially more importantly, they recently passed I think today actually they passed the funding bill to keep the government open through September, but we're also back at the debt ceiling. Do you remember the debt ceiling, that big fiasco? March 16th, the debt ceiling came back into play. We immediately hit it. So they actually are going to have to increase the debt ceiling come September as well. So September is shaping up to be rather a tumultuous period. Now, that all sounded horrible in a way, but there is good news. The actual underlying performance of the U.S. economy, it's not great, but it's decent. don't be fooled. If you start hearing somebody say, oh, it's been 8 years since our last recession, so this economic cycle must be coming to a close, we're due for another recession. In actuality, it's been an incredibly slow recovery. And if you really look at economic cycles, it looks like we're kind of towards the end of the beginning of the current economic cycle. A tremendous amount of economic growth is still dependent on consumption. It's really the only thing driving the economy at the moment, but that's not necessarily bad. And why that isn't bad is because for the first time since the recession, the U.S. economy looks like we're at full employment. This means the majority of people who lost their jobs back in 2008, who now want jobs, have them. So the pool of labor is less. And as the pool of labor shrinks, you have to pay more to hire your labor. As you have to pay more to hire, incomes go up, inflation starts going up, and so does consumption. Now, this brings on an interesting theory that I think, for this audience, may be quite pertinent. So, we have a theory related to how does this bring us to the next cycle, the next part of the economic cycle. One of the big missing ingredients has been productivity growth, and this is global. You read about all this amazing technology that's being developed, but you haven't actually seen any gains in terms of productivity in the economy, meaning, how much can one person make in terms of widgets. So, 50 years ago, one person might be able to have made 2 widgets in an hour. Now, because of technology, it might be 10 widgets an hour. But we haven't seen any of that productivity growth. And part of why we think that is because wages have been so low that if you're a company and you're thinking about expanding your business, there's so much uncertainty about the future, you have a choice. Do I spend $100 million on a new robotic system that will do the work of 5,000 people efficiently but costs a lot of money? Or do I hire 500 people when wages are still relatively cheap? And then if things work out, great, I can make that purchase later on. Or if things don't work out, I could fire these 500 people. So we think companies have actually been choosing to hire cheap labor. So as I mentioned, now that we're near full employment and wages are starting to go up, we do think we're going to see companies actually start investing more, capital investment, into these robotic systems. And on the point of productivity, President Trump has made a lot about the U.S. manufacturing sector, blaming basically everything from undocumented workers to trade deals on the sector's demise. But in actuality, as you could see from this white line, which is manufacturing employment, it's actually been decreasing pretty steadily since the 1980s. It did have periods where it accelerated, but interestingly, one of the few periods where manufacturing employment actually rose was following the passage of NAFTA. Admittedly, when China joined the WTO, that was rather bad for manufacturing. And it was bad because back in the early 2000s, if you wanted to say China was a currency manipulator and China was taking advantage of lower costs of labor, it was all quite true. The problem is it's not really true today. But digging into this a little bit deeper, this is quite interesting. Making manufacturing great again, in all truthfulness, it's still great in terms of output, right? The white line actually represents how much output the U.S. manufacturing sector is producing. It's basically near record highs, and the reason is productivity. Back in, I think when I did the calculation, in 1979, the average factory worker, this is all adjusted for inflation, could produce something like $50,000 in output. That was what they were producing. Today, that same factory worker could produce $250,000 in output. So Donald Trump has the priorities wrong in a way. If you really want to save manufacturing, let me go back one for a second. If you really want to save manufacturing, what you really need to do, he has one thing right. Corporate tax reform would help. Simplifying the tax code, making it easier for tech firms, and all firms for that matter, to bring capital back into the country would help. Where he has it really wrong, though, is when it comes to visas, right? While the economy as a whole is approaching full employment, when you actually look in the R&D programming space, we're far beyond full employment. It's very difficult to hire programmers in this country. And as manufacturing gets more sophisticated, as one person can produce more, the skill set's going up. And limiting, and you have a problem, because you don't have the labor force here who could do the job. Only a politician is going to tell you, we're going to take a bunch of displaced coal miners and make them computer programmers. It's not really going to happen. So two things need to happen. Short term, you need to fill those gaps with foreign workers who are qualified workers who are mostly foreign at this point. Secondly, you need to incentivize more students, more kids in the U.S. to study the STEM, science, technology, engineering, and mathematics, to prepare themselves for the future. That's the real problem, right? President Trump is worried about the trade deals and undocumented workers. What's going to happen in 5 to 10 years, and when suddenly you have the trucking industry, which directly and indirectly employs just under 10 million people, and this is where I think we're going to see the first really disruptive technology implementation. That's going to be in the trucking sector, when you're going to have self-driving trucks, which makes the most sense, displace 7 to 10 million people whose jobs pay above the average wage. I think this is going to be a big wake-up call for the U.S. government that they've had their priorities wrong. And as I've said, the future is the future of manufacturing, and not just manufacturing, service sector too. It's in the brains and not the hands. So this is also a really interesting chart. So Bloomberg has a wire. Bloomberg goes and transcribes all company earnings calls, presentations, etc. So on a quarterly basis, this is the number of those transcripts that mention artificial intelligence. And you can see basically since 2016, and this, I have it actually for first quarter, and it's gone to about 375. It has gone hyperbolic. So the number of, obviously it's not true artificial intelligence, but they just use that as a buzzword, but companies are thinking about it. So you can see the rapid rise in terms of companies now discussing artificial intelligence. And on my theory that as wages go up, workers are going to be replaced by robots, we've already seen it. There's been many states that have increased the minimum wage over the past year or two, far above the federal level. And in those states, Panera, McDonald's, and a lot of the fast food restaurants almost immediately replaced their staffs in their restaurants with kiosks. And that's the type of trend we're going to see happening. Also, like I said, that is what's going to spur capital investment and bring us to the next stage of the economic recovery. So I thought I'd just throw this in. It's a bit of a non sequitur, but interesting, because another big buzzy thing has been the Robo Advisors. Basically, you have passive and active investing. So Robo Advisor is something you put your money into, and it'll allocate it across a bunch of ETFs that are typically meant to track an index. That works really well when the correlation of stocks are all really high, meaning if all the stocks are trading mostly together, it's fine if you're a passive investor. But what this line indicates is this is the cross-correlation of stocks in the S&P 500. So when it's really high and you're a passive investor, it's great, because the active investor, when you factor in the fees, there's not really that big of an advantage. But since Donald Trump was elected, we've actually seen a plunge in the cross-correlation of assets in the S&P 500, meaning basically there's some value in stock picking again. I just thought that was interesting, so I throw that in. China. Now, China, there's a whole cottage industry of finding innovative ways of covering a country. And I'm just going to, and I think this is important, especially if you're talking later during the networking reception and you have any interest in China. We've actually created a suite of indices. In 3 charts, you could follow the entire China story in a way that is probably more sophisticated than 95% 99% really, of the US population, including people who work in finance. So the first chart I'm going to show you, the orange line is China's GDP growth. The white line is a proxy we built to track China's GDP growth on a monthly basis. And it works pretty well. And what this does is you take a bunch of high-frequency data points that are highly correlated to GDP, and you put that through a regression, and the output is this model. And what's particularly interesting about this model, you could see back in 2014, 2015, and the start of 2016, our model started going a bit below what China was reporting as their official GDP statistic. We do think there could have been some rounding going on, at the smoothing, let's call it, smoothing by the Chinese government on the GDP data. But a really interesting phenomena has occurred basically over the past half a year or so. And that is, our index is actually trending above China's, of what they're reporting as the official growth rate. So we think they could be smoothing the other way right now, and there's good reason for that. But mind you, one thing you should know, there's three really big risks for the Chinese economy. And really there's more, but these are the three big ones. Basically, a fallout in the property sector, trade disruptions, again, a risk for China. If Donald Trump were to go and say we now have a 45% tariff on China, you would see about 2% come off China's GDP growth, which would be very problematic. And capital outflows. This is the biggest one. The risk, China has a relatively closed economy, which buffers it from a lot of what's happening around the world. But if a lot of capital in China started finding its way out of China, this could cause, when you hear about these massive debt loads in China, that is the only thing that could trigger a crisis in that market, because they need a lot of liquidity to keep rolling over that debt. Now, here, there's not a lot of transparency with what the Pboc does. So the white line basically aggregates every piece of data you can that ties to that represents all the levers the central bank has, and basically shows if they're easing or tightening policy. So you could see back in 2015, they basically started easing monetary policy quite substantially, which helped support higher growth in China. Now the problem is, China is in the process of trying to rebalance its economy. They want to move away from investment, heavy manufacturing, the property sector, et cetera, and into services, high-tech manufacturing, the works. But what happened was in 2015, as represented by the blue line, the economic activity, these are also indices we created, in old industry, meaning everything they want to stop doing, plunged. So, okay, they were successfully getting out of what they wanted to do. The problem was the orange line is everything they want to be doing. That didn't grow. So the rebalancing wasn't working that well. So what they did is they threw in a whole bunch of stimulus, and what it did was actually kick the can on this whole rebalancing agenda. Meaning, it supported things like property, investment, the things they don't want to be doing. So the idea, have you heard of the concept of China's economy opening up? And I think some people think that this could happen in a couple of years. In reality, it's probably going to take more like a decade. And part of the problem is the property sector. And if there's one conversation piece you could take away from this about China, it's this, which is really interesting too. And that is that I always get the question, is China's property sector in a bubble? And my answer to that would always be yes. And then it really dawned on me, the answer is actually no. And why is that? So, if you're an investor in China, you really only have three options to put your money. A savings account, the stock market, which you might as well just go gamble, or property. That's the only way you could allocate your money. So property's been the only place where you could actually have appreciation and a safe store of wealth. So that's why it gets treated as an entirely different asset. So under those conditions, the property sector isn't really in a bubble. The problem is, let's say China's economy did open. So suddenly anybody could invest in China however they wanted to invest in China. But more importantly, people in China could invest outside of China wherever they want. People would immediately want to diversify. And in order to diversify, they're going to have to sell their property. So you basically immediately create a bubble, and that bubble immediately pops, and it takes down a lot of the Chinese economy with it. So until they solve this, they can't actually open China's capital account. And this isn't an easy thing to fix. How they're trying to fix it now is they're basically trying to modernize the financial system within China, meaning give people more investment options within China to diversify, so when they eventually do open it, you won't have that sell-off in the property sector. They had been trying basically to have property prices go up by 5% over 5 years, while real income goes up 20% to normalize supply and demand. But this is a funny story. The Chinese government has been very good at controlling the direction of property prices, but not the magnitude, meaning they can make it go up or they can make it go down, but they can't control by how much. When they were putting restrictions in on property purchases, one of them was if you're a married couple, you're only allowed to buy X number of properties. People are like, oh, wow, they're serious. But then the next month, what happened? The divorce rate went up 1,200%. And, ironically, they're trying to keep property prices under control right now. So they just put the same law in place with a stipulation. If you get a divorce, you have to wait a year to buy more properties. So that's a problem for them. On China, one of the last things I'll say is, I was talking to a Chinese government official recently, and he gave me this example about something that happened in China. And I lived out there for a while, and I said to him, I don't remember that happening. And he's like, oh, it happened 1,500 years ago. That is the mindset. Stability is key, and they will not jeopardize stability. So the process of actually opening the economy is going to take a very long time. And this idea of things, right now things look really good in China, and people are pretty euphoric. It's not going to last. They're going to use this opportunity to continue pushing forward the reform agenda. Things will slow down again, and suddenly people will be screaming hard landing, that China's going to collapse. But that's not true either. It's going to be this continuous volatile cycle in China for the foreseeable future. And if you ever see those headlines, I'm curious, raise your hand. Have you ever seen the headlines like the real growth rate in China is 0% or 2%? And the government figure is completely wrong? I saw a couple hands. I'll explain to you why that is. Leakage, who's the premier in China, was having a conversation in 2007 with the U.S. ambassador, and he said, "Oh, I don't look at the economics, the official GDP numbers in China. What I follow is rail traffic, electricity consumption, and loan growth." And then the U.S. ambassador sent a memo back and said, "This is what he looks at," and it was actually in WikiLeaks this came out. So everybody ran to create something called the Leakage Index. Like, this is how the leaders in China really looks at growth. And if you look at those constituents, that was all very important for China back in 2006, 2007. The economy has adapted enough where that's not as important anymore. Like, they want to stop doing steel production. That consumes most of the electricity. Rail traffic was mostly the raw materials for the heavy industry. They want to stop doing that. So back when people were saying this, those indicators would have indicated growth was at 0 or 2%. But when you look at freight traffic by truck, that was rising, and that's more the retail stuff, consumption, what they wanted to do more of. And if you looked at electricity consumption in the service sector, it was actually up. But after they did this, the monetary easing, as I mentioned, they did, and now growth is coming back up. That same index today would suggest the real GDP growth in China is 12%. But you don't see the people who said it was 2% saying it's 12% now. So keep that in mind if you ever see those headlines. And this is another issue. Every economy has a demographic sweet spot, meaning the majority of your population is working age. So they're both consuming and producing. Japan's sweet spot ended in 1995, basically almost coinciding exactly with when the lost decades began in that country. It doesn't mean, and China's is about to end. That doesn't mean China's going to be Japan. It just means it's going to be harder to generate growth. in China from a demographic standpoint. But this is scary. This is, on the left, Japan's population pyramid, meaning the allocation of the population by male and female in age. It's called a population pyramid because it's supposed to look like a pyramid. When it looks like this, actually what it means, and this is true, in Japan today, they sell more adult diapers than baby diapers, which from an economic standpoint, a demographic standpoint, is extraordinarily scary. Mind you, I was talking to one of the senior government officials in Japan saying, how are you planning on fixing this? The easy answer would be immigration, but that isn't going to happen. His response was robots. Not a lie. Actually, his response was robots, medicine. It sounded like the plot of the movie The Wolverine, if you've seen it. And that is, I'm not making that up. I was shocked sitting here talking to the guy. But the problem is, the chart on the right is China's population pyramid projected out to 2035. Or 2030. So basically, over the next 15 or so years, China is going to be facing a very similar demographic issue that Japan has today, which is why they lifted the One China policy. Interestingly, the oldest countries in the world are Italy, Germany, and Japan, the Axis powers. I still don't know why that is. I think it's coincidence. Now, the euro area. I'm going to have to go through this quickly because I want to do a little Q&A. So, unlike the US, where the markets have priced in this really positive outcome, markets in Europe have not, actually. They've been much more cautious. But in actuality, things look better in the euro area than they do here. You know, when it comes to the French election, the two candidates just had a debate tonight. It seems almost impossible that Le Pen's going to win that election. Polling in France has actually been very good, unlike the rest of the world. And she is, in fact, the last member of her party to make it to the second round was beaten by Jacques Chirac. It was our father, was beaten by Jacques Chirac by about 85%. So we're pretty sure this weekend the concern of Le Pen winning in France will be over. And there's other signs that this populist wave in Europe is dying. And they're the results of the Austrian election, and they're the results of the election in the Netherlands. So this is all quite positive. And even if Le Pen won, we actually don't think she would be able to engineer a so-called Frexit. Partially because, unlike the UK, something like 70% of the French population wants to remain in the euro area. So if there's some completely surprise result, just keep this in mind. I'll send you this presentation if you want, and this is just an outline of all the parties across the euro area who want to lead, how they're doing in each country, what their agenda is, and the likelihood of them winning. But the answer is not very good. Let's see, I'll skip over that. If you're following the euro or you have any exposure to the euro, you know, by the end of the year, the ECB is probably going to announce it's going to begin tapering its own asset purchases, which could potentially push the euro higher. Brexit, another interesting story. So Theresa May called an early snap election a week or two ago, which should help create what I like to call an orderly hard Brexit, meaning it's more likely she's going to be able to get approved her version of a hard Brexit, which should make it more orderly by reducing the uncertainty. But in actuality, uncertainty is still going to be quite high. And what many people didn't realize or didn't digest when they had the original vote back in June was that from the morning before and the morning after the vote, nothing fundamentally changed. Like nothing changed, no laws changed, there was no reason for anything to change. It was a hit on sentiment. So you didn't see that big of an economic impact in the data. But now that we're in this 2-year negotiation period, things will change, right? So there actually will be a hit on growth. And we think that, the UK economy is going to be about 2% smaller in 4 or 5 years than it is today because of Brexit. And something to keep in mind is, they need to be very careful because part of why London is such an important city is because of it's a great place to live. I lived there for a little while, and it also has access to the single market. So through this process, pending how hard the Brexit is, I mean, UK could lose access to the single market. So it could make London a less advantageous place to live. I'm sure like Dublin or Frankfurt might potentially like to see that, but that's one thing for people in this room to think about, especially if you're thinking about moving or expanding out to Europe. You're in a very uncertain period, and London will always be an important city, but it might lose some of its standing. So I will end with that to try to take some questions, if there are any questions. Thanks.
Here in the middle.
Okay.
Yeah, you had mentioned that the Axis powers all had bad demographic trends. What impact will Germany's position as really the powerhouse of Europe have with regard to their demographic situation?
What was really interesting about Germany? Mostly all these countries recognize they have this problem. And if you recall, when the Syrian refugee crisis first broke out, Germany raised its hands and said, "We want 1 million." And that was because, when you look at what refugees actually tend to be, generally young, highly trained, in a lot of cases, so skilled. And when you're the first to raise your hand and say, we'll take refugees, you have your pick of the litter, basically. So that was Germany recognizing the problem. Like the other countries, it's going to become harder for Germany to generally pick up growth. But one factor that Germany has to its advantage is it's part of the euro area, right? So people can migrate within the euro area. So labor from the south could then move into Germany. And another big advantage Germany has is why they weren't really impacted during the European crisis. In fact, they had their best ever industrial production numbers at the height of the European debt crisis. Is unit labor costs in Germany they kept really, really cheap, meaning they could produce this pen for the same amount of money in 2001 as they could in 2012. But for some reason, in a lot of the southern countries of Europe, the cost of producing this pen went from like 50 cents to $3. So when things turned really bad, Germany still had a really efficient system, and that's why they ended up doing okay. So, we'll have to see. Italy actually is going to, which is one of the older countries, that a year from now, that's going to be the thing the biggest concern we have in Europe, because they're the world's third largest debt market, behind the U.S. and Japan, and they are far from being on a sustainable fiscal path.
Yeah. Where was the U.S. on those population scales?
So the U.S. had been in fairly bad shape, but because of immigration from Mexico, right? There are about 12 million undocumented workers from Mexico here. They actually put the U.S. in an okay position. I think when I made the bar chart for the U.S., currently it was somewhere in the 2030s where that window would be closing. But if you kicked out 12 million immigrants, we'd be in a very similar situation to Germany, I think.
You haven't talked at all about Russia. Is Russia likely, obviously, enormous geopolitical issues, but economically, is it going to continue to remain relatively unconnected to Western Europe and having to replace many of the commodities that other countries end up importing, or do you see greater integration with the rest of Western Europe?
So I don't see integration for a while for Russia. Russia remains really an oil story. If oil prices are up, Russia's doing better. If oil prices are down, they're not doing so well. And I think that's going to continue to be the story. Even though they're trying to diversify the economy, there's still huge dependency there on oil. And I think it's next year, right? It's a pretty critical year because it's also an election in Russia. So I think that actually heightens geopolitical risk potentially. I'm not an expert on Russia. We do have a Russian economist who we hired recently because of questions like yours. And I was at an event with the Ukrainian and Lithuanian foreign ministers in New York. And the Ukrainian foreign minister basically said that Vladimir Putin isn't trying to rebuild the Soviet Union. He's trying to build a legacy. And right now, he hasn't built that legacy, and he feels like as he's continually tried to push the boundaries, he hasn't really gotten any pushback. And so they think that he's probably going to try to continue pushing some more boundaries. So I think there's more geopolitical risk in Russia than some might expect. Any other questions? I can't actually see very well because these lights are bright. So over here.
Going back to trade reform, we've heard a few pundits say that now that he's elected, Trump is going to back off. That he's cutting a deal with China and North Korea, that he's probably not going to go after the European markets. I don't know if you guys have an opinion on that, but there seems to be a lot less rhetoric around trade agreements now and going after those things.
Yeah, and I think the market was right in their assessment that there would be no major disruption to trade because President Trump promised two things he cannot simultaneously deliver, and that is protectionist policy and 3 or 4% GDP growth. He has to choose one or the other. And when push comes to shove, of course you're going to choose 3 or 4% GDP growth. So I think that explains partially why. Pulling out of TPP was actually a bit of a blunder. So TPP economically wasn't that significant for the U.S. It would have maybe moved GDP growth 0.1%, maybe 0.2%. Where that really mattered was it was a geopolitical disaster. Because basically China had been trying to say, we are the primary influencer in Asia, no one else. And TPP was an attempt by the US to basically group together with its allies and say, prove to them that, no, we are also still a major influence in this region. Pulling out of TPP handed Asia to China. Right? It opened doors for China that would have never been opened. Our allies there need to now look at China in an entirely new light, and the trade deals that we would have had with them, and the alliance, we'll still have alliances, obviously, but it opens China to do deals with them that would have otherwise been closed. So, I was in Ohio, and I told the group of people I was talking to, and speaking to predominantly, I think, Trump supporters, I said, listen, there's only two people happy about ending TPP. It's you guys and the Chinese. How do you rectify that? So,
I had two quick questions. One, at a really high level, when you look at the market, do you see any kind of immediate correction, or do you see it as something that's going to be sustained and maybe over a year or two, come back? And then, kind of tied to that, when you look at some of the newer technologies like AI or Bitcoin or whatever else, how do you factor in government regulation? Like, how is that unknown kind of priced in when you look at the potential there?
So on your first point, it's really interesting because if you look at, so markets, the treasury market is a better indicator of sentiment, how the market is feeling towards Trump's agenda than the equity market. And what you basically saw was rates peak on December 15th originally, which, and then when they peaked, that was the height of optimism in the rates market. And slowly start going down. They went down to a point where, you recall President Trump gave that speech to Congress to kind of clarify his agenda. That was because those cracks were beginning to form. And so when he gave the speech to Congress, the markets rallied again a bit, rates went up again a bit, but then nothing really happened. So then they started trending a bit lower again. And then, if you recall, last week, I guess it was, he released his tax plan in bullet point form. And that was, again, another thing to kind of keep this sentiment rising. So it's hard to say when it will actually crack, but they've kind of cornered themselves in a couple places. One is, well, they avoided the government shutdown, so that was a positive. But they've also said that, originally tax reform would be done by August. It's clearly not going to be done by August. And when details of the tax reform plan are released, it's going to be far more watered down than what was released. It's going to be basically tax cuts with some changes on the margins. And it's going to be interesting to see how the market reacts to that. But when back to my chart with the hard data, the real data, the soft data and the hard data, as they converge and as the real economic data doesn't start improving, that's also going to weigh on sentiment. So it's really hard to say what that trigger is going to be. But I have a feeling it'll come over the summer where we'll see the correction.
We've got time for
and on AI.
Time for one more question.
Quickly on AI, I think when the disruption happens in the trucking industry, Bill Gates had the idea that you should tax robots like individuals, like if a company has 100 robots. And I think that conversation is going to become more popular as we approach that happening. But I think we're a little bit off from that occurring, probably 2 to 5 years. Oh, wait, one more? Yeah.
Just quickly, how do you factor in government deregulation as well as the current 4-year hiatus on more government regulation?
So, it's hard from an economic perspective to say what the GDP impact is going to be on government deregulation. I don't actually think it's going to be that substantial. From a market's perspective, it's much easier to see. As all you need to do is look at the sectors that would benefit most from deregulation, which is like mining, financials, energy, and you could track their outperformance over the broader index. So you could kind of quantify a little bit how people are expecting earnings to change in those sectors by doing that. I wrote about this morning actually, and I'll end with this, the whole idea of repatriating funds from overseas and that driving economic growth. Chances are it'll probably help drive a little bit of business investment. But when you look at what Apple's doing now, Apple's issuing bonds not to invest in their business, but to fund share buybacks and dividends. So actually, the repatriating of capital won't have as substantial of an economic impact as people think. What you need to make it have a substantial economic impact is a return of what economists call animal spirits, meaning people having real confidence on, not blindly, but almost blindly, investing and expanding their businesses. That is one of the big things that is missing in the economy, and hopefully it's something that will come to some degree over the next couple of years. But, okay, so thank you very much. I hope you enjoyed that.
Well, thank you, Michael. I know that was a great overview and some really interesting markers and a playbook to watch the rest of this year and our futures unfold.